What are moving averages? Moving averages provide a way to smooth out price fluctuations to help you easily identify the actual trend direction. And what's great about smoothing out price fluctuations is that it removes unnecessary market noise which could cause confusion. Let's expand on this simple definition. Moving averages are an indicator used to represent the average closing price of the market over a specified period of time. It would be very useful to use it to find the trend direction, but they do not predict price direction. As you can see on the chart, this is what the moving average looks like when presented on a chart. As you can see, it's overlaid on the price. In this case, the price is represented by Japanese candlesticks. So, what is the use of having moving averages over the price? Well, it's to help us forecast future prices. And the reason of using a moving average instead of just looking at the price is that these trends, as they're moving down, obviously don't move in a straight line. Sometimes there's a small retracement, and sometimes it just goes straight down. And as price zigzags, a moving average's job is to smooth out these random price movements, as you can see, and show you the underlying trend. You may see moving averages have different levels of smoothness, or how clear the uptrend and downtrend is. And this is because there are different types of moving averages and there are different lengths to choose from. If you see a smoother moving average, you should know that it reacts slower to the price movement. And if you see a faster moving average, a choppier one, as if it goes up and down, the quicker it is to react to the price movement. So how would you make a moving average smoother, like this? Well, you should get the average closing prices over a longer time period. Choosing the most appropriate length of moving average depends on your personal trading style, but it's important to understand what the different lengths mean. A shorter length uses fewer data points, and so it is more reactive. The blue line represents the 9-period moving average, often the shortest period. But as you can see, although it is more reactive, it's more susceptible to give false signals. If you use a longer length, it includes more data points, so it is less likely to be affected by these small fluctuations, allowing you to stay in the trade longer. But if the length is too long, the moving average will be too smooth, and so you won't be able to detect any kind of trend. And so there are pros and cons to both lengths of moving average, using long and using shorter, but I would suggest using a mix of both. An important thing to note is that moving averages become self-fulfilling if you use the most commonly used moving averages, as if you go with the crowd, the price is bound to react at these levels, and so you can profit by knowing this. The most commonly used moving averages for day traders are the 10-period, the 20-period, and the 50-period moving averages. If you use the 10-period moving average, I would suggest doing very quick scalps, as it's extremely fast moving. If you use the 20-period moving average, you should be looking for more accurate trades for a slightly longer period of time. And if you're using a 50-period moving average, I would use this only as confirmation, helping you stay in a trade for longer, allowing you to catch more profits. If you're a swing trader, what I would suggest the time periods that you should use is the 20 period, the 50 period, the 100 period, and the 250 period. The 20 period is perfect if you want to do short-term swing trading. The 50 period is a standard, so at key levels would be very reactive to price as many people are using it, and as I said before, it would become a self-fulfilling prophecy. The 100 period is also another one that works very well for support and resistance. I would suggest that you use this on a daily time frame if you do decide to swing trade. The 250 period is very, very good if you want to use it on a daily chart to identify long-term and very accurate trade opportunities. Now you know how to identify the correct length to choose when trading. How do you choose the correct type of moving average? First things first, you should know that there are two main types of moving averages: the simple moving average and the exponential moving average. And the main difference is that the exponential moving average is faster, and so it changes direction earlier than the simple moving average. And this is simply because the exponential moving average gives more weight to the most recent price action, which means that when price changes direction, the exponential moving average recognizes this sooner than the simple moving average. And this is evident here when the red one, which is the exponential moving average, moves faster than the blue one, which is the simple moving average. It happens right here, and it happens again right here. The simple moving average allows you to quickly see the overall market sentiment and allows you to identify if a pair is trending or not. However, the simple moving average provides less signals but also later signals, meaning you miss some of the move. But the benefit of this is that it provides less wrong signals during volatile times, meaning it has a higher accuracy. Next, looking at the exponential moving average, you can see that is more reactive, and this is, as I said earlier, because the exponential moving average gives more weight to the most recent periods of time. So it gives quicker signals right here. And because the exponential moving average reacts faster when the prices change direction, it also means it's more vulnerable to giving wrong signals for giving it too early. So let's say the price were to retrace during a rally, the exponential moving average will say that the trend is reversing, and the signal for this reversal will come too soon, meaning you enter into a bad trade, causing you to lose money. Thank you for watching. You should now be able to identify the correct length that will suit your trading style, as well as the correct type of moving average that will suit your trading style. If you like this video, please do show it by liking and subscribing to our channel. And I'll leave you guys with a quote. Learn to sit back and observe. Not everything needs a reaction.